everyone, welcome back to my channel. In this video, we will continue the topic, How to read financial statements like an accountant, Part 2. In this Part 2 video, we will focus on financial ratio analysis. Let's refresh our memory what we have discussed in our Part 1 video first. Previously, we have discussed what the financial statements look like. We provided sample balance sheet, sample income statement, and cash flow statement. Please feel free to revisit the Part 1 video if you need to. We also discussed briefly what are the 5 key financial metrics: liquidity ratios, leverage ratios, efficiency ratios, profitability ratios, and market value ratios. In this video, we will pick 10 most commonly used financial ratios and will discuss what they are, what they indicate. It will help you understand more about financial statement analysis. The first one, current ratio. Current ratio equals to current assets divided by current liabilities. It shows if a company has enough short-term assets to pay off its short-term debt. Current ratio above 1 usually indicates good liquidity. The second one, quick ratio. Quick ratio equals to current assets minus inventory, the difference over current liabilities. Inventories are excluded from quick ratio calculation because it is not a liquid asset and takes longer to convert to cash. Quick ratio is more strict than current ratio. Quick ratio above 1 usually indicates short-term liquidity. The third one, gross profit margin. Gross profit margin is also part of the profitability matrix. It is one of the most widely used profitability ratios. It compares gross profit to revenue. It shows how much profit the company makes after accounting for the direct costs associated with doing business. A company with high gross margin compared to its peers likely has the ability to charge a premium for its product or services. On the other hand, a pattern of declining gross margin may indicate an increased competition. The fourth one, net profit margin. It is one of the most important profitability ratios. Net profit margin compares net profit to revenue. It tells a business' ability to generate revenue after all expenses are accounted for. All expenses include every cost, like cost of goods sold, operating expenses, interest, and taxes. A business with high net margin reflects its strong and healthy business. The fifth one, return on assets, ROA. ROA equals to net profit over total assets. It tells how much profit the company generates from its assets. For example, if ROA equals to 10%, it means for every $1 of assets, the company generates 10 cents of profit. Higher ROA indicates better assets utilization and stronger management performance. The sixth, return on equity, ROE. ROE equals to net income divided by shareholders' equity. It tells how efficiently a company uses shareholders' equity to generate profit. Higher ROE means better returns and stronger management performance. For example, if ROE equals to 10%, it means for every $1 of shareholders' equity, the company earns 10 cents of profit. The seventh one, earnings per share, EPS. Earnings per share equals to net income minus preferred dividends. The difference is compared with weighted average common shares. It shows how much profit is attributable to each share. The eighth one, price to earning ratio, or PE ratio. P/E ratio equals to share price divided by earnings per share. It shows how much the investors would pay to receive $1 of earnings. It determines a stock's potential for growth. The ninth one, debt to equity, or D/E ratio. D/E ratio equals to total debt divided by shareholders' equity. A higher D/E ratio not always good or bad. Higher D/E ratio can be good when a business generates stable and predictable cash flows and indicates a high leverage business. But please note, total debt not equals to total liabilities. Total debt is short-term debt plus long-term debt plus other interest-bearing payment obligations. For example, notes payable, bonds payable, or long-term liabilities are part of the debt, but accounts payable, accrued expenses, and deferred income are not debt. The 10th one, interest coverage ratio. It equals to EBIT divided by interest expense. It measures how easily a company can pay off its interest on its debt using its operating expense, EBIT. Strong ratio indicates the company has stable earnings and low financial risks. Now we have covered all the 10 commonly used financial ratios. Please feel free to leave any comments or questions below. If you like this video, please give it a thumb up, subscribe for more career tips, and let me know in the comments which topics you'd like me to cover the next. Thank you so much for watching.